Welcome back to the deep dive. For many of you, especially our senior listeners, figuring out retirement income and taxes, well, it can feel pretty
It
complex.
definitely can be.
So buckle up. Today we're digging into a brand new law, the One Big Beautiful Bill Act, the OBB Act, passed just this July 2025.
Right.
And our mission really is to break down one key part,
Mm.
the expanded senior deduction. We want to pull out the most important bits for you.
Yeah.
We're talking potentially an extra deduction, maybe up to $6,000 per person, or $12,000 for a married couple if both qualify.
What's really interesting here, I think, is that this isn't, just another deduction added to the list.
Okay.
It's what's called an above-the-line deduction.
Yeah.
And anyone who deals with taxes knows that means it cuts your adjusted gross income, your AGI, directly,
Okay.
which then affects a whole bunch of other things, like, most importantly, how much of your Social Security gets taxed.
Mhm.
And this is crucial, it's temporary,
Oh.
only for tax years 2025 through 2028. So it creates this specific 4-year window you need to know about.
That above the line part, that sounds like the real game changer here. So let's unpack that. Who exactly gets this? What are the numbers?
Absolutely. Eligibility is pretty simple. You need to be 65 or older.
Okay.
If you are and you're filing, say, single, it's up to $6,000. For a married couple filing jointly, if both spouses are 65 plus, that maximum doubles to $12,000.
12,000, wow.
But it is targeted. It's really aimed at low and middle income seniors. There's a phase out based on your modified adjusted gross income, MEGI.
Right, MEGI, which for listeners, that sometimes includes things like tax-exempt interest, doesn't it? It can push that income number a bit higher for some calculations.
Exactly right. It's a slightly broader income measure. So the phase out starts at $75,000 MEGI for single filers
75K,
and $150,000 for married couples filing jointly.
double that. Okay.
And the deduction shrinks by 6% for every dollar you go over those limits. So like for a single filer, that $6,000 benefit disappears completely once their MEGI hits $175,000.
Got it. So it's really focused. Now, here's where I think it gets really interesting. You said above the line reduces AGI. Tell us more about that impact, especially on Social Security. It sounds like more than just a tax cut.
Oh, it is. It's much more strategic. See, this deduction isn't an either with the standard deduction. You get it whether you itemize or take the standard. It stacks on top.
So everyone eligible can potentially benefit.
Yes. And by lowering that AGI number before other calculations, it can seriously cut the taxable portion of your Social Security benefits.
How much?
Well, it depends on your specific situation, obviously. But it could potentially shift you from having, say, 85% of your benefits taxed down to maybe only 50%,
Wow.
or even from 50% taxable down to zero. Imagine suddenly having a chunk of your Social Security become tax-free.
That's huge for cash flow and retirement.
Yeah, definitely. And it can affect other things tied to AGI, too, like medical expense deductions, maybe thresholds for investment income taxes. Reducing AGI is the core mechanism here for lightening the tax load on Social Security.
Okay, so connecting this to the bigger picture,
Yeah.
this 2025 to 2028 window, it really demands some smart planning, doesn't it? What should folks be thinking about?
It absolutely does. This 4-year period is, well, it's a prime planning opportunity. One big strategy, especially if you're 70 and a half or older,
Uh-huh.
is using qualified charitable distributions, QCDs, sending money straight from your IRA to charity.
Right. Those reduce your income directly.
Exactly. They bypass your taxable income altogether, lowering AGI and AGI, which can help you stay under those phase-out thresholds for this new deduction.
Clever. Keep more of the deduction by lowering NGI with QCDs.
Precisely. Another thing is timing Roth conversions. A big conversion spikes your MEGI, right?
Yeah, definitely.
So you might want to do any large conversions before 2025, or maybe wait until 2029 to avoid losing this deduction during its limited window. It's about being proactive.
So what does this all mean for you listening? Well, it means this isn't just, another line item. It's temporary, yes, but it could be a really powerful tool for saving on taxes for these next 4 years.
Yeah, to sum it up, the expanded senior deduction is very targeted, it's temporary, but it offers potentially significant tax savings, especially by cutting the tax on Social Security for many retirees. It's a specific tool for a specific time.
And here's something to think about as we wrap up that tax landscape. It will change after 2028 when this thing expires. So the question for you is, how will you use this 4-year window? How can you shape your financial strategy right now to make the most of this unique legislative moment? Think about how planning now might affect your retirement for years to come.